Most people think finance is about stocks. They watch the ticker scroll by, they hear about Nvidia hitting a new high or some meme stock exploding overnight, and they think that's what the financial system is. But here's the truth that almost nobody tells you. The bond market is roughly 3 times larger than the stock market globally, and it is the actual foundation on which every other financial asset is priced. If you don't understand bonds, you don't understand interest rates. If you don't understand interest rates, you don't understand why stocks crash, why housing markets freeze, why currencies collapse, or why governments rise and fall. Bonds aren't boring. Bonds are the operating system of the entire economy, and everything else is just an app running on top of it. Let's start with the basic idea, because it really is simple at its core. A bond is a loan. That's it. When a government or a corporation needs money, instead of going to a bank, they go directly to investors and say, "Give me your money now and I will pay you back later with interest." You hand over, say, $1,000. In exchange, you get a piece of paper, or these days a digital entry, that promises you regular interest payments, called coupons, and then the return of your original $1,000, called the principal, at a specific date in the future, called maturity. Simple, right? A loan with a schedule. But this simple instrument is where the entire concept of the price of money gets discovered. Here's where it gets interesting, and where most people's understanding breaks down. Bonds aren't just held until maturity by whoever bought them first. They trade. They get bought and sold constantly on secondary markets, and their price moves. But the coupon payment, the actual dollar amount printed on the bond, never changes. This creates the single most important relationship in all of finance. When bond prices go up, yields go down. And when bond prices go down, yields go up. They move in opposite directions, like a seesaw. Why does this matter so much? Because a bond's yield is essentially the market's real-time verdict on the cost of borrowing money and the risk of not getting paid back. Here's where it gets interesting, and where most people's understanding breaks down. Bonds aren't just held until maturity by whoever bought them first. They trade. They get bought and sold constantly on secondary markets, and their price moves. But the coupon payment, the actual dollar amount printed on the bond, never changes. This creates the single most important relationship in all of finance. When bond prices go up, yields go down. And when bond prices go down, yields go up. They move in opposite directions, like a seesaw. Why does this matter so much? Because a bond's yield is essentially the market's real-time verdict on the cost of borrowing money and the risk of not getting paid back. Think about it this way. If a bond pays a fixed $50 a year and you bought it for $1,000, your yield is 5%. But if fear sweeps the market, inflation spikes, or people suddenly doubt the borrower's ability to repay, nobody wants to pay $1,000 for that bond anymore. The price falls to, say, $900. That same fixed $50 payment now represents a yield of about 5.5%. Nothing about the bond itself changed. What changed was the market's perception of risk and opportunity cost. This is the mechanism. This is how the market translates fear, greed, inflation expectations, and economic growth into a single number, the yield. And that number then ripples through everything. Now, here's why this actually runs the world. Government bonds, especially U.S. Treasury bonds, set the risk-free rate. This is the baseline return you could get with essentially zero risk of default, because a government that can print its own currency is, in theory, always able to pay back debt denominated in that currency. Every other asset in the world is priced relative to this baseline. Want to know if a stock is a good investment? Analysts discount future company earnings back to today's dollars using a rate built on top of the Treasury yield. Want a mortgage? Your interest rate is priced as a spread above the yield on the 10-year Treasury note. Want your business to get a loan? The bank prices your risk against that same benchmark. Corporate bonds, real estate, private equity, even the valuation of your own retirement account, they are all, whether people realize it or not, anchored to the bond market.
Now let's talk about the part almost nobody explains well: duration and risk. Not all bonds behave the same way when rates move. A bond that matures in 3 months barely reacts to interest rate changes. You'll get your money back so soon that it doesn't matter much what happens to rates in the meantime. But a bond that matures in 30 years is extremely sensitive to rate changes because you're locked into that fixed payment for decades, and even small shifts in expectations compound over that entire time frame. This sensitivity is called duration, and it's why long-term bonds can actually be more volatile than many people assume, sometimes even losing more value in a bad year than stocks do. The 2022 bond market, when the Fed hiked rates aggressively and long-term Treasury bonds suffered historic losses, taught an entire generation of investors this lesson the hard way. Bonds are supposed to be the safe asset, and they are safer in terms of avoiding default, but they are absolutely not immune to price swings.
Then there's credit risk, which is the other major axis bonds move on. Government bonds from stable countries are considered close to risk-free, but corporate bonds, or bonds from financially unstable governments, carry the real possibility of default, the borrower simply not paying you back. This is why a bond from a shaky company might offer a much higher yield than a Treasury bond of the same maturity. That extra yield is called a credit spread, and it is the market pricing in the probability of disaster. Watching how these spreads widen or narrow is one of the best early warning systems for economic trouble that exists. When credit spreads blow out, it usually means smart money smells recession or default risk building in the system, often well before stock markets catch on. This is also why bond markets, not stock markets, are often the first place financial crises actually reveal themselves. The 2008 financial crisis wasn't fundamentally a stock market crisis. It was a bond market crisis, rooted in mortgage-backed bonds that were rated safe but were actually stuffed with bad loans. When those bonds failed, the entire structure of trust and fixed income collapsed, and stocks crashed as a downstream consequence. Sovereign debt crises, like what happened in Greece, are bond market events at their core. Countries losing the confidence of bond investors, causing yields to spike so high that borrowing became unsustainable. Even currency crises are often bond stories in disguise, since foreign investors dumping a country's bonds usually means dumping its currency right along with them. So, when someone tells you they understand finance but they've never really studied bonds, what they actually understand is the surface, the flashy, emotional, headline-grabbing part of the market. Stocks are the weather. Bonds are the climate. Interest rates set by the bond market determine the cost of capital for every business, every homeowner, every government on Earth. And that cost of capital determines what gets built, what gets bought, and what eventually breaks. You can ignore bonds and still make money in a bull market, but you cannot claim to understand how the financial system actually works, why crises happen, or why the Fed's decisions ripple through your own life without understanding the mechanics of the bond market first. It is not the boring corner of finance. It is the foundation everything else stands on.